Welcome, aspiring investors. Whether you're just starting out or looking to expand your financial knowledge, you've come to the right place. Today, we will unravel how to choose ETFs and mutual funds. These investment options have revolutionized the way people invest, offering flexibility and a range of choices to suit different financial goals. So stick with us till the very end and you will be an investment selection superstar. Don't forget to like, comment, share and subscribe for more invaluable content. These investment vehicles offer a simplified and potentially diversified approach to growing your wealth. ETFs, or exchange-traded funds, are like a basket of securities that you can trade on an exchange, much like a stock. Mutual funds, on the other hand, pool money from many investors to purchase a diversified portfolio of stocks, bonds or other securities. Whether you're a novice or have some experience, understanding these tools is crucial. ETFs and mutual funds can help you achieve your financial goals, whether you're saving for retirement, a child's education, or simply looking to grow your wealth over time. We are giving you the keys to understand how to choose fund or combination of funds, whether just starting out in your new retirement plan, or you are a seasoned investor that just wants a reminder to refresh their application of the basics. This guide will equip you with the knowledge to make informed decisions. We'll break down the complexities and provide you with the insights needed to navigate the investment landscape confidently. We'll explore the differences between ETFs and mutual funds, such as how they are managed, their fee structures, and their tax implications. Understanding these differences can help you choose the right investment for your needs. We'll analyze key metrics for evaluation, including expense ratios, performance history, and risk levels, and point-to-point loss timelines. Knowing what to look for can make a significant difference in your investment outcomes, as well as help you understand risk, so you can sleep well at night even when your funds are down. Diversifying your investments can help spread risk and improve potential returns. We'll show you how ETFs and mutual funds can be used to build a well-rounded portfolio. Join us as we demystify the complexities of investing and empower you to take control of your financial future. With the right knowledge and tools, you can make informed decisions that align with your financial goals and never let anyone steer you wrong. Let's embark on this journey to financial freedom together. We'll provide you with the resources and support you need to succeed. Don't forget to like, share and subscribe for more insightful content, and read the description as we will place important resources in it. Stay tuned for more tips, strategies and updates to help you on your investment journey. ETFs, exchange-traded funds, and mutual funds share a common goal: pooling money from multiple investors to invest in a diversified portfolio of assets. However, they differ in key aspects. ETFs trade on stock exchanges, much like individual stocks. Their prices fluctuate throughout the trading day. In contrast, mutual funds are priced once a day at the end of the trading session. This difference in pricing mechanisms affects their liquidity and trading flexibility. ETFs offer intraday trading, while mutual funds are bought and sold based on their end-of-day net asset value, NAV. Understanding these distinctions is crucial when choosing the right investment vehicle for your needs and risk tolerance. Another example are crypto ETFs. There are so many new ones, such as an XRP ETF, Ethereum ETF, Solana ETF, Bitcoin ETF, Dividend ETF, AI ETF, and many more. This gives an investor access to crypto in different ways than was previously available. Navigating the world of ETFs and mutual funds requires understanding key metrics. These metrics are essential tools that help investors evaluate the potential and suitability of different funds. These metrics provide insights into a fund's performance, risk profile, and cost structure. By analyzing these factors, investors can better understand how a fund operates and what to expect in terms of returns and risks. Expense ratio. This represents the annual percentage deducted from your investment to cover the fund's operating expenses. It includes management fees, administrative costs, and other operational expenses. Lower expense ratios are generally more favorable for investors. A lower expense ratio means more of your money is being invested rather than used to cover fees, which can significantly impact your overall returns over time. Performance history. Analyzing a fund's historical returns helps gauge its track record. This involves looking at how the fund has performed over different time periods, such as 1 year, 5 years, or even longer. However, past performance is not necessarily indicative of future results. While a strong track record can be a positive sign, it's important to consider other factors that might affect future performance, such as market conditions and changes in the fund's management. Portfolio holdings. Understanding the underlying assets within a fund is crucial. This includes knowing what types of securities the fund invests in, such as stocks, bonds, or other assets. This provides insights into the fund's investment strategy and risk exposure. For example, a fund heavily invested in technology stocks may offer high growth potential, but also comes with higher volatility. If you own several mutual funds that have similar strategies, you may have overlap of several companies, so you should be aware of exactly what each fund you own holds. You could own 3 funds that overlap so much that you may not have the diversity that you are trying to achieve. By carefully evaluating these metrics, investors can make more informed decisions aligned with their financial goals. This involves not only looking at individual metrics, but also understanding how they interact and what they reveal about the fund's overall strategy and potential for growth. ETFs and mutual funds offer a wide array of investment options, catering to diverse investment goals and risk appetites. Let's delve into some specifics. Index funds, for example, passively track a specific market index, such as the S&P 500, providing broad market exposure. Then there are sector funds, which focus on specific industry sectors, such as technology, healthcare, or energy, allowing investors to target specific growth opportunities. There are newer ETFs focusing on crypto now, some available through brokers like the XRP ETF, Ethereum ETF, Solana ETF, ETF Ethereum, and Bitcoin ETF. And let's not overlook bond funds, which invest in a portfolio of bonds, providing income and diversification to an investment portfolio. Understanding the different fund specializations empowers investors to construct a well-diversified portfolio aligned with their individual needs. Investing in individual stocks can be enticing, but it requires significant time, research, and risk tolerance. The allure of potentially high returns can draw many investors to this path. However, the journey is fraught with complexities and demands a deep understanding of the market. Now let's compare. ETFs and mutual funds offer a more accessible and diversified approach. These investment vehicles pool money from many investors to purchase a broad range of assets, providing instant diversification. This means that instead of putting all your eggs in one basket, your investment is spread across various stocks, bonds, or other securities. Stock picking involves analyzing individual companies, their financials, and market trends. This requires a keen eye for detail and a solid grasp of financial statements, earnings reports, and market indicators. Investors must stay updated with the latest news and trends affecting their chosen companies, which can be a full-time job in itself. This can be time-consuming and complex, especially for novice investors. The sheer volume of information and the need for continuous monitoring can be overwhelming. Mistakes can be costly, and the learning curve is steep. For those without the time or expertise, this approach may not be the best fit. ETFs and mutual funds, on the other hand, offer instant diversification by investing in a basket of assets. This means that even if one asset underperforms, the impact on the overall portfolio is minimized. Professional fund managers handle the selection and management of these assets, leveraging their expertise to optimize returns. This spreads risk and reduces the impact of any single stock's performance on your overall portfolio. Diversification is a key principle in risk management, helping to smooth out the highs and lows of individual investments. By spreading investments across different sectors and asset classes, the overall risk is mitigated. While individual stocks offer potential for high returns, they also carry higher risks. The volatility of the stock market means that prices can fluctuate dramatically in a short period. This can lead to significant gains, but also substantial losses. Investors need to have a high risk tolerance and be prepared for the possibility of losing their investment. ETFs and mutual funds provide a more balanced approach, suitable for both beginner and experienced investors. They offer a way to participate in the market without the need for extensive research and constant monitoring. For beginners, they provide a safer entry point into investing. For experienced investors, they offer a way to diversify and balance their portfolios. In conclusion, while individual stock investing can be rewarding, it requires a significant commitment of time and expertise. ETFs and mutual funds offer a more accessible and diversified alternative, making them a valuable tool in any investor's arsenal. So remember the wise one rule: there are only two smart things to do with money: build assets and reduce debt. The third thing, with a smile, is to invest in trends that you know are going to stay. But as always, choose wisely. AI or crypto, anyone? This week, SEC Chair Gary Gensler acknowledged in a formal Senate hearing that Ethereum ETFs have been approved and are just waiting for the final paperwork, meaning they should be available sometime this summer. How exciting!